I'd like to show you why knowing your why is the start of your journey. Without a strong why, it can be so difficult to reach your maximum potential. My name is Dr. Jason Balara, and every week I meet with real estate investors and mindset specialists that are taking action in order to build a life according to their own terms. We will break down what drives successful people and allows them to achieve at such a high level. If you are a professional wanting to break through, or simply someone that wants to hear an inspiring story, the Know Your Why podcast is made for you. Hi, everyone. I'm Jason Balara, and this is the Know Your Why podcast. Today, I'm here with Evan Holladay. Evan is a real estate developer and investor with over $375 million and 1,965 units of multifamily real estate developed and invested. As we said before, that number is probably bigger now, I would guess. But I'll stop there, Evan. And first of all, thanks for coming on the podcast. I really appreciate you taking the time to join me today.
Yeah, likewise, Jason. Thank you for having me. I appreciate being here and also being able to talk about knowing your why. That's one of the things I'm most passionate about. So excited for the podcast.
Awesome. Yeah, me too. Well, why don't you just start by, kind of telling my listeners your background, a little bit about yourself and what you do. Obviously your numbers suggest a lot of success, but, kind of what got you there? How'd you get started?
Yeah, definitely. So our group, Holladay Ventures, we founded it 3 years ago. And we specialize in doing impact-driven investing, specifically around attainable, affordable housing, and with a backdrop within multifamily and mixed-use developments. So we typically do larger scale, 200 plus unit developments with first-floor retail. We'll do nonprofit partnerships. We incorporate a lot of sustainability into our communities and to our developments, and I think what separates us from a lot of other developers is we're intentional developers, meaning we really take a holistic approach from day one of our development, saying, how can we help the residents, help the community, and help the environment all at the same time, and help our investors throughout the entire process. And I think going into, knowing my why, just briefly, because it plays into all of this, is really, I think for me, I was very fortunate. I had very loving parents, and they taught me the value of really taking care of others and helping others and loving others. And I think that's really, really has become a big part of my ethos and my big why. And when I had that why, I just didn't know what to apply it to. And originally I thought that was being a doctor. And so going into college, I wanted to be a doctor. And then I realized it was like science and chemistry, not my thing. But I still wanted to help people, but I was like, nope, not being a doctor.
Yeah.
But I figured out very quickly, I was lucky that through that process, I saw this big student housing development going on at the university I was going to. I went to University of Louisville, and I saw this big $55 million student housing above with retail and commercial below. It was just a really cool project. And I mentioned it to one of my mentors. I said, that's really cool. Like, I would love to do something like that, just really offhand. And he's like, really? He's like, I know the developer. I'd love to introduce you. I was like, heck yeah. And it just snowballed from there. I impressed the developer, got a bunch of people out to his groundbreaking. And that led me into the world of development. I started working for that developer, learned really like soup to nuts, A to Z, about the development process. And I was hooked. I was like, all right, this is what I got to do. This is what I'm meant to be doing. But I knew, I was like, but I still want to help people. And I felt like building student housing that's luxury pricing and, luxury amenities and everything's like $3,000 a month per bed. That just wasn't fulfilling for me. And so I was like, how can I combine my love of real estate and my love of development, where I can literally build, new buildings and new communities out of nothing, with my passion for helping other people and, helping others who really need help. And that's when I learned about affordable housing, impact investing, public-private partnerships, where we actually partner with the government. They help us provide some of the funding, and in return, we're able to keep our rents at a below market basis. So families, working class families that are making on average 30 to 60 grand a year, which increasingly is a good majority of the United States right now, we're able to house those families and not have them be cost burdened on a daily basis with their rent. And so our communities, our residents are paying no more than 30% of their monthly paycheck. So the other 70% they can spend on healthcare, education, wellness, transportation to get their kids to and from school, whatever it is. It just eases that housing burden, which more and more families are feeling today. And so once I got into that, I was hooked, started working for a developer that ended up, while I was there, we grew to be the number one affordable developer in the year. Like I think it was 3 or 4 years in a row. And from there, I was like, all right, I love this. This is my passion, but how can I do it even better? How can we do it even better and do it differently? And that's when we started Holladay Ventures, really with the mindset of being, like I said earlier, an intentional developer, where we really take a holistic approach from day one of every development. From the very first time we look at a site, we think about it from a holistic approach as a team and collaborate through that. And then also, once we get our communities up and running, we really emphasize and focus in on resident empowerment services. So we're going to be providing life coaching to all of our communities, all of our residents at or below cost or no cost life coaching. And really with the goal of saying, how can we get our residents out of affordable housing? How can we give them the tools, the mindset, the confidence, the network, the relationships, whatever it is that they need to be able to get out of affordable housing, empower them to be able to do that. That is a big, big part of our why, because we don't want to be building affordable housing for families that will stay there for generation after generation. The goal of Holladay Ventures is to think massively, think big, and think about how can we totally erase the cycle of family generational poverty and living in affordable housing over and over again. So that's really a big part of our why. But I think it all boils down to, I was lucky I had great parents who taught me how to love others.
Yeah. I mean, fantastic. There's like a million questions now. I'm like, there's so many things here that I want, I have not had another guest who has been in the affordable housing space. So I think that's, it'll be really cool. I some specific questions about that, but obviously it's very mission driven, and, impact, giving back, all of that. So very, very, very cool. But also I just love development. I think it's something that for myself that I ultimately would really probably like to end up in that space. Just, I like building new, I like to see it from start to finish. Like value add is cool, but really I want to like you said, let's look at it from a holistic approach. So I think, now I'm even more excited about this. But first, it's funny because, most of the people, and I know you have a podcast, like most of the guests, it's like, oh, I'm a veterinary surgeon, like people are other things. And then they come into the real estate space, but not you. I mean, you're actually unique in the sense that you sort of just, this is what you did coming out. I mean, I don't know that you probably had little jobs before that, but in terms of what am I going to do with my life? I mean, you started it at a young age in, sort of connecting with this developer at college. So that's, you can call it fortuitous, lucky, but it wasn't, because you saw something you were excited about. You said that to a mentor. Like people in this space always talk about, make sure you always talk to everybody about what you're doing. Let them, and it's
exactly.
And you could expand that to ask the questions, right?
Yeah.
Like that's super cool. Who's doing that? How could I be around something like that? And it's sometimes as simple as that. And I know it wasn't that simple. I'm sure there's a lot more that went into, but in reality, like asking that first question, got you there, right? It got you started, and you found, and you did, you went and learned the business. So, I think that's super cool. And also, like I said, unique to, most of us, myself included, did something else, you maybe had some, I feel like a lot of people have parents that were in it or whatever it is, like there's some other background connection, but very cool that you kind of got there early. Would you mind just talking a little bit about you said you learned soup to nuts, A to Z, what does that mean? Like tell people, obviously you could talk about this, I'm sure, for hours or days, but when you say that, I think people picture, okay, you're buying a piece of land and building apartments on it, right? There's that, that's probably, to a lot of people, that's as deep as you can think about it, but that's certainly not it, and probably not even the hardest part. Like, maybe just talk through the process a little bit so people understand what that means.
Most definitely. Yeah, I'm glad you brought that up. And real quick, going back to what you said previously, I completely agree. I think you always have to talk about what you're doing, be open about what you're doing, be open about your goals. And I think the more you put out into the universe, the more it's going to come back to you. And so there was definitely a huge amount of luck involved with my mentor having that relationship already, but it didn't just immediately lend to a job. I had to then, he helped open the door, but I had to push my way through the door. But I think that you're exactly right. I think putting yourself in those opportunities is really where the magic happens, and you get to find your why and you get to find your purpose. And then answering your question about the development process, it's really is like, it's such a complex, it's like a living organism. It's like every deal is so different too, but really I like to boil it down to a couple different principles. One, I think really our job is really just being consummate project managers. And really, I think to be a good developer, you have to know how to see the day to day, like what needs to be done today, but also what needs to be done high level over the next 2-year life cycle of a deal. And that's really, and backing up a little bit, typically your cycle, your timeline of a deal from the time you get a site under contract to the time you close on it, meaning like close on the land, close on your financing, starting construction, that's typically about a 2-year process. And then from the time you start construction to the time you move in your first resident, and really, let's just call it 100% construction completion, is about 2 years now. It used to be 1.5 years. COVID and pandemic have really pushed that out to 2 years. So, and then from the time you start leasing to the time you start, you're 100% occupied and you're on your permanent financing, that's another year to lease up the property. So really, your full timeline of a project from idea to 100% leased up is about a 5-year life cycle. And so the majority of our work on the development side is from that 0 to 2-year mark. And that's really where the deal is put together. And really, once you finance it, there's still some risk through construction, and you have to manage the construction process. You have to manage the lease up. But really, the vast majority of the work is on the front end. And so really, from start to finish, our goal is to manage risk and manage capital accurately, or what's the right word? Adequately. Really, our goal is to be spending as little capital as possible while finding out as much information as we can as possible. And so we're basically, I think of it as like different stages of decision making. And so each, before we even put a site under contract, we are running the financials, we're running a pro forma, we're running a hypothetical scenario of, hey, how many units do you think we can get on 10 acres? Rule of thumb says it's 20 units an acre. So, and if we need parking, if it's flat, you can get more units. If it's hilly, less so. So we look at all the variables of the site, the zoning, the location, the entrances. We take all that into account. We do a very rough estimate, a conservative rough estimate of saying, hey, 200 units could fit on the site. And what's our ideal unit mix? We put that in, we put in all of our variables, and we try to be as conservative as possible. We know that it's going to take probably 1.5 years to 2 years. So we look at, very conservative interest rates on our loans. We really just look at everything as high as we possibly can and say, hey, does the deal still work after all of these variables are pushed up to the max? If it does, then that's when we pull the trigger and we put it under contract and negotiate with the seller. From there, then we really go into, again, spending as little money as possible while trying to find out as much information as we can about the site, the zoning, the location, the politics. The local politics are a huge piece of at least what we do. If you want to rezone something, you pretty much always have to have council member and community support. And nowadays, most of the zoned land is already picked over. So a lot of the development sites we're looking at, we have to rezone to multifamily or commercial or mixed use. So that's a big part of it. Is before we spend $1, I go to make sure I have a meeting with the council member to make sure they are on board and they support, and also just see if they have any ideas or see if they have any vision for this site. I usually try not to say, hey, this is what we're going to do, and you're going to take it or leave it. Yeah. I say, hey, what do you want to see here? What, this is ultimately your community, and this is ultimately going to be, your neighbors that are living in this development that we're going to build. So what do you want to see here? And then once we gain their blessing, that's when we start spending money. We figure out the environmental on the site. We figure out the soil. We get a survey done. If there's any wetlands, we figure that out. So really focus in on the third party reports. And then there, it's really just figuring out, like, again, little by little, talk to your partners, figuring out where your financing is going to come from. You talk to banks. We do a lot of tax credit financing to help pay for the development. The government helps provide tax credits. We sell those credits to investors, and then they give us cash that helps pay for roughly 40% of our development costs. So we're making sure our development aligns with the goals and basically the scoring criteria for tax credits. So we're closely aligning with that when we do our site selection. We have constant conversations with our financing teams, our tax credit council, making sure our development falls within the rules and the guidelines of tax credit financing. And then we talk to property management, we talk to our GC, we talk to architects and engineers, make sure our design works, make sure the design matches the cost. So we talk to the GC to constantly get pricing. And it's really just an iterative process where we're constantly talking to all the different partners, just trying to figure out as much information we can while spending as little money as we can. And really, once you get to a certain point, there's different milestones, but once you get the property rezoned, once you get the financing approved by the state agency, and once you have your plans into permits, that's really when you've decided, like, hey, we're moving full steam ahead on this thing, and we're going to start to spend real money. So that's typically the last, call it 8 to 12 months of a project. That's when you spend the vast majority of your money. And that's when you're really committed to the project. And you believe that, barring massive unforeseen circumstances, you will close that deal. But that is really, I think of it as like as a line graph, and over the 2-year cycle, and you're spending, trying to stay as flat as you can on spending money. And then all of a sudden it's like a hockey stick curve at the very last, like 6 to 8 months. It really like pops up because that's when you're committed to the project and you spend the big money. And over that timeline, we'll typically spend about $2 to $2.5 million. We try not to buy any land before we really are ready to move dirt and break ground. Again, for that same reason, we're trying to take as little risk as we can and spend as little money as we can before we need to.
Yeah. I mean, it's so interesting to me. I think probably the majority of people, what they think when they think of development, they're actually thinking about those middle 2 years. Right. They see a building, right? There's something to actually go up. They don't realize that you've already spent 2 years working on that, getting to the point of ready to build. They also don't realize that after there's a building in place, people don't magically just show up and live in it. Like there's more work to be done then. So it's interesting, kind of to hear about all those parts. And I think, you sort of said it nonchalantly, but I think another thing people don't realize, like if you're spending $2.5 million essentially to get to the point where you've committed to building this building, like there's a lot of risk in these deals on your part and your partners in upfront, right? So it's like they're if you go all that, I mean, it can happen in any real estate deal. You can lose money in sort of your due diligence period, but like that's a long due diligence period. And a lot of money kind of over that amount. So seems like I don't know if you would say that the risk is higher for you kind of in the beginning than people doing whatever, a value add multifamily or something like that, where it's already a building, right? It's there, it can be there. You have to figure out, and as you mentioned, likely change the zoning so that a building can be there. So it's kind of sounds like that's a heavy front-loaded risk. I would say. Would you agree?
Yeah, most definitely. I think that's why we really try to, especially on the front end, like we won't spend $1 until I know we can get rezoning and political support, because I know without that, your deal is, dead on arrival. And so there's certain key things that we've learned over the years that, certain variables that you need to get figured out before you spend more money, because they are ultimately the ones that decide the fate of your development. And I think that's what we always try to do is we'll spend the initial, first couple $100,000 of our own capital to basically pursuit costs of development. And we do that because that is the riskiest capital. But as you learn more information, as you spend more money, your risk goes down as well, because you're learning more variables, you're learning more about the site, you're getting more political support, you're getting financial support, whatever it is. And the momentum behind your project starts building. And that's when we bring in our investors, and they help us raise the remaining $2 to $2.5 million to get us over the finish line. But we only bring in investors until at the point we know, hey, this is actually a real thing, and it's 98% chance this is moving forward. But you are right. Compared to a value add deal, compared to any acquisition deal, it is significantly more risky. But if you're able to figure out and navigate how to manage that risk well, then you're able to basically build something brand new that will be one of the newest products, for the next 15 to 20 years. And the way we do it, it's affordable. So we're basically providing something that in a lot of places and a lot of markets are like 100% below market rents for a comparable new construction in the same area. So it's kind of mind blowing that it's even gotten to that point, but it just shows you we'll have just built-in demand for residents for the next 15 to 20 years at least, because of the rent points and the quality that we're building at.
Right. So I guess one thing you mentioned before, I have a lot of questions, but you had said you're doing a lot of mixed use. Is there a reason for that? Is that a way to sort of diversify within the building? Why would you choose to do mixed use? Obviously, I assume the commercial or the retail space in these mixed use buildings, that's not affordable housing, right? So maybe you make up some of that, income. I'm not sure. Why would you specifically
that's a
choose
good question.
that?
Yeah, it doesn't have to do with revenue. It really just for us has to do with quality design and intentional development. Going back to what we were talking about earlier, we just believe that if we can put retailers in there, if we can put community services in there, then ultimately that's a benefit for our residents. So they love where they live, and hopefully it provides positive services or positive places to meet other people and connect with others. And it really gives them more community feel rather than just a multifamily setting. And we typically, honestly, the way we do our underwriting is we try to build in some form of commercial retail with no income underwritten from that retail or commercial space. That way we can really offer below market rent. And that way we can help encourage, if it's not yet a retail location at that time, then we can help it become a retail location by offering below market rents.
Okay, that makes sense. And so, it's a resident experience type of reason behind
exactly.
that.
Exactly. Yeah, it really goes back to the resident empowerment for us.
Excellent. Another thing you talked about, and I've definitely heard this from other people I know that have done some development, but the relationships with essentially the local government, councilmen and things like that. Nobody wants the county or the city on their bad side in any, sort of commercial real estate type of venture. But right. I imagine it's especially important here when you're looking to rezone and all of that. So my question, I think really what I'm maybe getting towards is what markets are you focused in? Are you local to those markets? Do you think that helps you? I guess I'll start with that sort of line of questioning.
Yeah. So we currently are focused in on Nashville Metro. But we're currently also looking in Texas and South Carolina and Georgia. And so Nashville specifically, yes, it has a huge advantage to us to being in the market, especially over the last, I've been working here since 2014 and have lived here for the past, I think 5 years now. So that makes a huge difference. It's just, you're a local, you have relationships,
Right.
you have built-in rapport. That goes a huge distance. And then the other markets that we're working in now that we're looking at new developments in, it always just comes down to relationships. Typically, it will come from somebody that I've met over my years of networking with real estate people or impact-driven leaders. And somebody will reach out to me and say, "Hey, Evan, I live in X city in Texas, and I'd love to figure out how to build affordable housing or bring affordable housing to my city. We really need it."
Yeah.
And I have relationships with city leadership. Well, to us, that like immediately moves up to the top of the list of like potential deals and potential cities for us to look at, because one of the hardest things about our job has been education of why cities need affordable housing for both community standpoint and the economic standpoint. And so anytime we can lower that barrier to entry of saying, "Hey, city already gets it. They know the need. I don't have to explain it. I don't have to educate that. And I have a warm introduction." And we all really, a referral goes so much further than a cold introduction.
Sure.
So anytime we can find that where it aligns with our interests, it aligns with the city's interests, that's always where we try to go as far as pursuing development. And then, of course, really the South is seeing so much explosive growth right now. And that, of course, exacerbates the need for affordable housing. So that's also why we're looking in those states.
Yeah. I mean, certainly, and you made this point before, but I mean, certainly inherently you're going to have a lot of demand. There's no doubt that that'll be, you won't have trouble, sort of leasing this up. So then that I guess brings to mind, how do you, as the developers, how do you make this profitable? Right. Because I guess just to, for the listener, like generally a lot of these, essentially commercial real estate is valued based on what you're achieving for rents.
Right.
Right. So if you're building to essentially know you're achieving less rent than you could in another part, how do you balance that? And I get it, like the community impact, all of that. It's phenomenal to have a cause, but like at the end of the day, you can't keep doing it if you're not somehow making.
You gotta make money at the end of the day.
Right. So how does that? I know tax credits help. Like, kind of how does that maybe come together again at a high level? I'm sure there's a ton of stuff that goes into it.
Yeah, definitely. That's a great question. So really, it boils down to, like you just said, the tax credits cover 40% of our development costs, and so in essence, we're selling those credits. We're getting 40% of our costs covered day one by outside equity. And all that outside equity partner wants in return is the tax credits. They want the tax credits, the losses, and the depreciation. So if you're an LP or if you're involved in a syndication, you typically get like your share of investment and ownership. You get that return and losses as well. And so in our relationship with our investor, they get 100% of the losses, 100% of the depreciation, and 100% of the tax credits. And that's all they want. So, it's a bummer we don't get the losses and depreciation, because that's a great benefit of commercial real estate. But also at the end of the day, they really don't want any of the upside, and they don't want any of the cash flow or any of the fee. And so that's really where the benefit is for a GP, a partner that puts together developments like we do, is you can, if you underwrite the deal well, you can potentially get into a deal, you'll be reimbursed your pre-development costs, and then you won't have to put any of your own money into the deal at that point. So you won't have any capital in it. And then you can, typically, it depends on the state, you can get a 10 to 15% developer fee from the deal, and then you'll get 90% of the cash flow after that. And so it's a different type of model where our investor doesn't want cash flow. They don't want returns. They're not shooting for, 15% IRR. They're just shooting for a return on their capital in the form of tax credits, losses, and depreciation. So we basically get everything else outside of that. And that is really our incentive. So it's typically a much higher developer fee than a market rate deal. It's typically lower cash flow, but higher fee. And then also the back end, after 15 years, you can buy out your tax credit investor for a nominal amount. And then you will own the project 100%.
Okay. That I mean, it's a very different strategy than sort of most of what, and obviously then you have to have, sort of a specific investor pool in that.
Right.
Like so many people are always talking about, oh, you should get in deals for cash flow. You should get in deals for cash flow. And I get it. I get why a lot of people say that, but I actually think that's what you really need to know is what your investment, like what do you need to get out of investment? And for some people that's cash flow, but obviously for the people investing in your deals, what they need is tax advantages essentially. And so you just have to find the right kind of investor pool.
Yeah, that's a great point. And the other thing I would add is our investors are actually typically banks, because banks are required. There's Community Reinvestment Act of 1986 that basically said banks couldn't redline lower income neighborhoods. And they actually have to, each bank now, I think it's annual or biannual, they get a CRA score. And that CRA score is based on how much they are investing in affordable communities. They can open branches, they can invest through tax credits, they can, do donations or do philanthropic events, different things like that. But banks have to be investing in every part of a neighborhood. They cannot redline. And so most banks get a significant amount of their CRA score from investing in tax credits for affordable housing. And so majority of our investors are banks. So they get the CRA score and they get the losses and depreciation and the credits, which they can offset their income from other parts of the bank.
And this kind of sounds like a phenomenal model now. Like it's just almost like a win all around, because I think that, as you said, you're creating, first and foremost, like creating this product that really has a need in a lot of the cities. Like a lot of people are getting priced out of their apartments because of the rapid pace of rent growth. And then you're creating, so there's affordable housing, you're creating sort of a residential experience for them. And then on your end, now you've got almost like the perfect partnership where I guess that means you don't get the tax benefits, but at the same time, like you're getting everything else, right? So it's kind of, it's just a win. I think it's a win all around, right? It's a win for those banks get what they need. You're getting what you need. And then of course the tenants are getting a quality brand new product with, kind of with affordable rents, which is fantastic. When I know you said after 15 years, you can kind of buy out those tax credit investors. So what is your exit plan for these types of deals? What do you, so we know what that first 5 years looks like with, sort of getting it ready, doing the construction and then the lease up. And then once it's stabilized, I assume that's kind of maybe the easy part, but what is your exit plan for these, or these things you're trying to hold forever? How do you manage that?
Yeah, that's a good question. Everything affordable, our goal is long-term ownership. And really our goal is, with 15-year initial compliance period, but really states have added on another 15 years. In some states like California, I think it's now like 50 years total. Tennessee, where most of our deals are, is just 30 total. But at the end of 30 years, we could look at other options, but really our mission and our passion is affordable housing. So what we will do is at some point, whenever the project needs a good rehab and an update, then we'll take it back into the tax credit program. And you can get tax credits to help pay for 40% of the rehab costs. And you just basically sign up for another 30 years of affordability. And that's really what we see, being able to create long-term affordability and have that impact is really part of our mission. If it's market rate, we do some market rate development as well. We'll typically build those, stabilize those, and then sell those assets to long-term holders, unless it's just a really core asset in a great location. Our goal really is on the affordable side. So we're honestly, part of our doing the market rate is to help feed the affordable business.
Right. I mean, it makes a lot of sense. It really does seem like it's hard to find. no business is perfect, but it's hard to find like a real downside to this, right? In especially with your, and maybe you do have something like, maybe you can point out some things there, but like if you kind of lump it all together, the impact that you're having, along with, some of these benefits to you as the developer and all of that.
Yeah. I definitely would, in full transparency, there are definitely downsides or challenges, as I would call it, to the business. I think really the big couple that I can immediately think of are just, there's a lot of red tape. There's a lot of bureaucracy. There's a lot of, you at times you really just want to pull your hair out because you're going through all these, jumping through all these hoops to get the funding, to make sure it matches, there's tax exempt bonds, there's tax credits. Right. There's all these rules and huge rule books that you have to follow to get that funding.
Yeah.
And also you have to jump through all the hoops to even get it in the first place. And so there's a lot of brain damage you have to be willing to go through, I'd say, in order to be able to do this affordable development. It's not for the faint of heart. You really have to just love it. But it is also, it's fun because it's like creative financing. Like we really do some really fun, creative ways of structuring our deals. And sometimes you have to do that just to be able to get the deal done, because you are dealing sometimes with limited resources. So I think that's the exciting part, but also one of the most challenging parts about this. And I would say just, community sentiment around affordable housing hasn't always been the greatest. I was actually just telling somebody this morning that I really think we're shifting in the last couple of weeks. I've noticed, having been in affordable for, I guess, the last 11 years, I've seen, from when I first got started, nobody wanted to talk to me and everybody hated affordable. They're like, get the heck out of my town. And, we don't need the ghetto. And, they just had all these negative stigmas around affordable. And now, I kid you not, neighbors are now telling me hey, we love this. Could you actually make it more affordable? And I was like, wow, I've never heard that before. Most times people are saying, don't bring the terrible affordable housing in my backyard. Now everybody's like, could you bring more of that? That'd be great. And I'm just like, wow, this is game changing. I think there's still a lot of communities that don't feel like that, but it's just amazing to see that communities are now flipping their mindset about affordable. And I think too, it's because we're building quality affordable housing today, not just us, but a lot of developers out there are building really quality communities that are totally you look side by side at a market rate or affordable, you wouldn't be able to tell the difference. They look the exact same, they act the exact same. And so I think that's the really powerful piece is we're no longer building the 1960s barrack style public housing. We're building quality stuff and really being able to help the residents, and people notice that and they're like, oh, wait a second. Now we need a ton of it. And that we have this massive housing crisis. Sorry about that. We have this massive housing crisis. I'll say it one more time. Hold on. Hopefully this can be edited out. So we have this massive housing crisis that now every city across the country is like, hey, how can we get some more of that affordable housing? And hey, Evan, can you come to our town and bring as much affordable housing as you possibly can? So I think that's a promising sign. I don't think we're all the way over yet, but right. I think that's really promising. I think the other challenge, though, is now every other developer and every other real estate investor, we have rising interest rates, we have rising labor costs, we have rising material costs, and on the development side, we have rising land costs. So you have all these variables that are going up, and our rents are going up, but not nearly as much as a market rate developer because they're capped and they only go up once a year, and it's only a set percent. So that's really been one of our bottlenecks has been, how do we pay for all these rising costs without also, with staying within our income limits and our rent limits.
Right. Yeah. Yeah. I guess. Yeah. And that's probably what maybe the gist of what I was getting at before in terms of how do you do this and also still make knowing what's happening, on our value add deals, just what, a year ago might cost you $6,000 or $8,000 to renovate a unit. And now it's 12 or 15,000. And it's just, it has changed very dramatically. And so I imagine in a lot of cases on these market rate deals, as you mentioned, like, okay, well, now our rents have to be whatever they have to go up to kind of match that. But if you're capped, then that creates a significant problem unless someone creates a program for affordable housing supplies, or you know what I mean, like some way to in a similar manner keep the materials that have to go to these things, down, like they do for you with tax credits, whatever it is. Like, hey, here's a hey, Home Depot, whatever, however you want to say, whatever the wherever the materials are coming, but we'll give you tax credits to help supply these.
That's interesting, thinking further down the supply chain. I think really the two biggest things I can think of are if cities would allow by right more dense zoning along major corridors and major transportation corridors specifically for affordable housing, ideally. But I mean, really, if you just give more rights to landowners along corridors to build any sort of dense mixed use or even just market rate multifamily, the more units, the better it is for the market, because it's just supply and demand. And also lowering parking requirements is a huge one, at least along major transportation corridors. And last one I would say is, completely went from my head. I don't know, it'll come back to me, but there's many different things that could be done. But it is, I think there's tools that could be done. I think it just takes massive political effort to be able to get those things done. Yeah.
Shifting government at whatever level is not no easy task.
Yeah.
Oh man, it's very cool though. Well, let's shift gears. Actually, just I don't want to keep you all day. This stuff is very fascinating to me, but we'll kind of get to the part of the show where I ask you the questions that I like to ask every guest. The first one you touched on a lot. This show is called Know Your Why. I ask every guest kind of what is your why, and you went into that in the beginning. I just wanted to kind of give you the opportunity if there's anything you want to add there to kind of expand upon it.
I think just in a nutshell, I think I was very blessed with loving parents, and they taught me to love others. And I think maybe as a good reminder to all the parents out there is, remember that the words you say and the messages you share with your kids, they do remember them, and it stays with them for the rest of their lives. And it usually has a massive impact on what they do and the way they see the world.
Yeah, I have young kids, and it is shocking how much they pick up. You have to be very careful and be sure to lead by example for sure.
Yeah.
Second question is what's something about yourself that maybe isn't common knowledge? Special skill, a hobby, and anything you're comfortable sharing just to let people know you a little better.
Yeah. Probably two of my favorite things to do. They're both newer activities for me, but I just love them so much. Downhill mountain biking and wake surfing. So those are two of my favorite things to do. Just recently came back from a trip from Bozeman. We went downhill mountain biking at Big Sky, and it's just so much fun. You go so fast. And anyways, those are my two things.
That sounds terrifying. I like wake surfing, but yes, the downhill mountain biking sounds terrifying to me. That's a very high speed to be shooting down a mountain with no snow to cushion your fall if it happens. Super cool. When people hear this and they want to reach out to you, Evan, what's the best way? And put whatever you want in the show notes.
Yeah. I would say check us out on Instagram at Evan Holladay. Holladay is Holladay. And our website, if you're interested in learning more about what we do. And also if you're interested in investing, it's holladayventures.com.
Awesome. Okay. We'll put that in the show notes. My final question for you is, what piece of advice would you give to someone who's getting started? And you don't have to necessarily say in development, although, that seems to be your obvious area of expertise, but just kind of getting started, wanting to invest in real estate. What would you tell them?
I would say be confident in yourself and your abilities, and find mentors who align with your why and your goals, and do whatever you can to bring value to them. in any way you possibly can. Like my first opportunity came from bringing, basically they asked me to bring out people to their groundbreaking. And I said, okay. So I got a bunch of my buddies in my fraternity to help pass out flyers. And they ended up, I think, getting over 200 people at their groundbreaking. And that's what helped me get the job. And so I think doing whatever you can with no expectation in return, trying to bring value to mentors, that's how you will align yourself with mentors.
Yeah, makes total sense. And I think it's certainly a common theme, just figuring out a way to bring value to others without that expectation. It's not a transaction. It's a true,
right.
Just wanting to be there and be a part of it in whatever capacity that takes. So
yeah,
super cool. I love this conversation. Like I said, this stuff is super fascinating to me. So thank you, Evan, for coming on today. I really appreciate you taking
Thanks for having me.
Yeah, absolutely. And everyone listening, if you like this, which I'm sure you will, this was very, very interesting, but please like, rate, and review, and that way we can get this out to more people. All right. Have a great day, all.
I'd like to show you why knowing your why is the start of your journey. Without a strong why, it can be so difficult to reach your maximum potential. My name is Dr. Jason Balara, and every week I meet with real estate investors and mindset specialists that are taking action in order to build a life according to their own terms. We will break down what drives successful people and allows them to achieve at such a high level. If you are a professional wanting to break through, or simply someone that wants to hear an inspiring story, the Know Your Why podcast is made for you.